Hi there, welcome to Kneppy Invest. Recently, I completed a series on the best performed companies on the ASX since 2013, and these companies were confined to those that had a market cap above $1 billion as of May 31st, 2023. And I thought, why not look at the best performed companies on the ASX with a market cap less than $1 billion, hence this particular video series. I've already done the initial video in this series, and that featured the 5 worst performing companies, or maybe it was 10, either 5 or 10 worst performing small cap companies, market cap less than $1 million on the ASX since 2013, and also included honourable mentions. Those companies that did not quite get into the top 30 best perform ASX small companies with a market cap below $1 billion since 2013. Now, there are some rules, what's another good word for it? Maybe not rules, but there are some, we'll just say some rules that I have used to draw up a list of these top or best performed companies on the ASX since 2013. So let's have a look at those rules just now. Here are the rules I used to draw up this particular list with the aid of Guru Focus. The first rule I've already discussed. I've only included companies with a market cap below $1 billion. If you want to look at those companies that performed really well since 2013, that have a market cap above $1 million, you can look at my previous series. Now, that market cap below $1 billion is of May 31st, 2023. The reason I use that as a cutoff date is because I didn't want any overlap of companies in that original series and this particular series. The second rule I had used is I wanted these companies to be revenue making. I wanted all these companies to have a viable business. I didn't want any story stocks at all. The reason I decided on that rule is because I am looking for factors, looking for reasons why these companies have been successful over the past 10 years. So I'm looking for revenue growth, return on invested capital, or even gross margins. And for those companies that have zero revenue, they don't have any of that. They just have a story. They just have words. They have zero numbers. So no story stocks, only those companies that have revenue. For instance, one of the companies I excluded from this list was BrainChip. Now, you might argue that BrainChip has a little bit of revenue, but it's only a little bit, and it's only has been generating revenue over the past few years. The third rule I did use may be controversial. I didn't want to include any mining companies. Now, a few reasons why I decided upon that. Main reason is mining companies tend to be completely cyclical, and I didn't want cyclicality to be the reason why they were the best performing companies in the last 10 years. For instance, if I had this list ending 2016, there'd be 0 iron ore companies within that list. But over the past 7 years, since 2016, you'd have some of the best performing companies on the ASX are those iron ore companies, because iron ore had a bottom in 2016. So I wanted no cyclicality in understanding what drove the performance of these particular companies. Now, there is a possibility I might do another series titled 30 Best Performed Mining Companies on the ASX since 2013. I'm 50-50 on whether I'm going to do that series. And again, that would be as of May 31st, 2023. I've already drawn up the companies that would be included in that list. So leave your thoughts in the comment section on whether you would like me to do that video series on mining companies. And the fourth point, the fourth rule, probably the most important rule, this is completely subjective. Is the right word? Subjective, objective. This is not my opinion. This is just based off total return. So zero opinion, completely objective list of companies using just total returns over the past 10 years. And I just want to emphasize this particular point, an important point, that past performance is not a predictor for future success. Now, I would definitely follow this particular point when you're looking at year-to-year performance. For example, if a company performs really well this particular year in 2023, doesn't necessarily mean that company will perform well in 2024. In fact, we have seen time and time again that in some years, the best performing companies were the worst performing companies the previous year. So from year to year, this is a really important point to pay attention to. But when you extend the time period, I think you can draw some conclusions from those companies that have performed really well over a 10-year period, that there is probably a better chance of success. Those companies will continue their performance over the next 10 years. Not an absolute, and this is definitely true for a company that is among the worst performing companies on the ASX since 2013, MA Offshore. That company performed terribly between 2013 and around about 2021. But since 2021, that has been an absolutely stellar performer on the ASX. Share price of that company has risen from about 20 cents, maybe even below 20 cents, to $1.50, because it does seem like that company has turned things around. And not only that, they are a cyclical company and they are taking advantage of what they are doing. So MA Offshore is definitely a proof that past performance is not a predictor for future success or future failure. Before we move on to company number 30, let's have a look at the honourable mentions that I did provide in the previous video. And these are companies that did not quite make it onto the list. However, these companies all provided their shareholders with a greater than 12% return, total return over the past 10 years. And I don't think I mentioned this in the previous slides, that total returns is just share price movement plus dividends. Always have to include dividends. Now, a lot of companies within this list don't have really big, substantial dividends, but some of these companies do. And in fact, I own two of these companies right now. Bell Financial Group, which hasn't really performed well over the past few years, Prime Financial Group, and I've also owned a few of these companies in the past, including Mitchell Services and Infomedia. Other companies here, Austel, Brisbane Broncos, Ridley, Cog Financial Services, Lycopodium, and Emundi Group. And more than likely, I won't own some of these companies ever. Definitely will never own Brisbane Broncos, but definitely these companies have performed really well over the past 10 years. So don't exclude these companies from your consideration. Now on to the company that came in number 30 of the 30 best performed companies, small cap companies on the ASX since 2013. And coming in at number 30 is Cogstate, a company I have not owned in the past, never owned this company, and I've done scant research on this company. So this is a neuroscience technology company optimizing brain health assessments to advance the development of new medicines and to enable earlier clinical insights into health care. This company has performed spectacularly well over the past 10 years. Revenue growth 8.3% per year. I probably would prefer that to be above 10%, but you can't complain with 8.3%. You notice that there is no earnings per share growth, no dividend growth, because for many of these companies, if you go back to 2013, they were not profitable, and many of these companies don't have dividends. Nice gross margins of 54.2. I would like that to increase. That would be a good sign moving forward. Return on invested capital above 10. That is actually one of the things I am looking for in regards to a high quality company. Return on invested capital, return on equity above 10. And an analyzed total return of Cogstate over the past 10 years is 16.5% per year. If you just own Cogstate in your portfolio over the past 10 years since 2013, you're probably a very happy investor right now. Now, one of the common themes I did find among these initial 5 companies in this particular list is shares on issue have all increased substantially over the past 10 years. And I found that to be quite interesting. A lot of investors are quite skeptical about capital raisings because they don't like the dilution, and they've could be concerned that the management won't use the cash to grow the company in the future. But it can be shown just by looking at these first 5 companies that management have used capital raising quite well to grow the company. In fact, if these companies didn't do any capital raisings, possibly the company has not grown at all. So for Cogstate, the markup of this company has increased from 30 million to 290 million. So almost a 10-bagger over a 10-year period just in market cap. But shares on issue have increased from 80 million to 190 million. So this company has gone back to the shareholders for more cash, and more than likely that cash has been used to grow the company. So don't be necessarily wary of capital raisings. Don't underestimate the power of capital raisings, because the whole reason these companies decide to list on the ASX is to have better access to capital to grow the company in the future. So that's probably the common theme you're going to see among these top 30 companies, small cap companies on the ASX since 2013. A lot of these companies have grown because of capital raisings. Not all of them. I can think of one company right now that's not, Nick Scarley, that's going to come later in this series. That company has not grown their shares on issue at all. But many of these companies have grown because of capital raisings. Now, I'm also going to look at charts for all these companies. Now, many of these companies will have a similar theme where the share price has gone from the bottom left to the top right. Not all of them will have that particular signal. And when you do see the share price going from the bottom left to the top right, it's really important to note the journey, because the journey can be quite wild at times for these companies. In fact, the big difference I have found from companies above $1 billion to those companies below $1 billion is just the wild ride we will see for some of these companies. And with Cogstate, this wild ride is quite evident when you look at this particular chart. There are periods of time when you want to be owning this company, and there are periods of time, and fairly long periods of time, when the share price of this company falls a fair way. For instance, the first part of the wild ride for Cogstate was between about the middle of 2015 and the start of 2017, when the share price of Cogstate went from about 12.5 cents to about $1.38. But then the share price fell from $1.38 back down to 12.5 cents from 2017 to the middle of 2019. So almost 2.5-year ride of the share price just going down. And then from the middle of 2019 to the start of 2022, so we're talking about another 2.5 years, the share price went from 12.5 cents to a high of $2.63. So for a lot of these companies, you will see obvious trends. And some of these trends can last for multi-years. So 2.5 years, 3 years, maybe even 4 years. And I think this is going to be a common theme among all these top 30 companies, because I wouldn't necessarily say these companies are going to be high quality, unlike those companies that were featured in the other series with a market cap above $1 billion. Many of those charts were bottom left to top right. Now, the journey of these companies might have that similar bottom left to top right, but the journey is going to be much more wild, as evident by Cogstate's chart. Now, I'm going to be quite honest with you. Quite a few companies that did make it into the list actually surprised me. And this is the first one that surprised me, SideDev. I actually do own a small amount of shares in SideDev. I've owned shares in this company for, I think, about 5 to 6 years now. And the share price, just like Cogstate, has gone on an absolutely wild ride. Now, let's have a look at the financial performance of SideDev since 2013. Revenue growth, exactly what I want to see. 21.4% per year. Now, this company is not yet profitable. And of course, because it's not yet profitable, there is no dividend. Gross margin, 27.9. That is one thing I'd like to see increase. I'd like to see the gross margins of this company increase from 27.9, and return on invested capital way too low at 1.5. So definitely I'd like to see that increase from here. But the annualized total return since 2013 is a really nice 16.9% per year. Of course, I have not held this company over the past 10 years, only over the past 5 to 6 years. Now, look at the market cap. And this is the reason why I was surprised to see this company on this particular list, because I knew the market cap was quite low at $62 million. But 10 years ago, the market cap of SideDev was $2 million. So the market cap of this company has increased 31-fold since 2013. Now, it's on a low base of $2 million, but still, if you've been a shareholder of this company since 2013, you have loved the journey that SideDev has gone on, apart from the shares on issue. Now, shares on issue have increased 6-fold, or almost 6-fold, since 2013, increasing from 32 million to 190 million. So definitely there has been some dilution for shareholders, but I don't think you would mind that dilution, because the market cap has increased significantly and you received an annualized total return of 16.9% per year. And SideDev's chart is absolutely fascinating, because you can see a long period of time when the share price did absolutely nothing. Now, I think I mentioned I bought shares in this company about 5 or 6 years ago. In fact, it was middle of 2019. So that was 4 years ago I bought shares in this company. But between 2013 and the middle of 2019, share price of this company did absolutely nothing. And during that period, this company had very little revenue. That's one of the reasons why revenue growth has been really good, because very little revenue back in 2013. There was a little period of hyping this company back in the middle of 2016. You can see share price increased significantly in 1 week on coinciding with really high volume. But that interest waned away fairly quickly. But then the interest started again in the middle of 2019 when the company started to increase and really ramp up their revenue. And that's why the share price of this company went from about 8 cents to a high of above $1 in a fairly short period of time. But since that high of about $1 or just above $1, and that was in the middle of 2021, the share price has fallen a fair bit from about $1 all the way down to about 24 cents. So this company has seen a 75% decrease in share price over about a 2 and a bit year period. Now, I don't think the performance of a company has met market expectations. That's why the share price has fallen. However, the revenue of this company keeps on increasing. And I want to see the margins increase, and I want to see this company reach profitability and also operating cash flow and free cash flow positive on a consistent basis. That's the one thing I'm missing, or this company is not showing the market. One thing that is missing from this company right now. And that's why the share price has been under pressure over the past 2 years. Coming in at number 28 is another company I own, Smartpay. And this is going to be a common theme among all these top 30 companies. Quite a few of these companies I actually do own. And some of these companies I actually do consider to be high quality. I'm not quite there with Smartpay. This is definitely the highest quality of these first 5 companies, but I don't necessarily think this is a high quality company just yet. I think it has the potential, but not quite yet. So this company designs, develops, and implements payment solutions for customers in New Zealand and Australia. Some people compare this to Tyro Payments. I own both. I probably do prefer Smartpay just yet because of the financials. So let's have a look at the financial performance of this company over the past 10 years. So revenue growth, 9.2% per year. So again, I probably would prefer that to be above 10%, but I could take 9.2%. Earnings per share growth, 13.9% per year. So when you look at revenue growth, earnings per share growth is greater than revenue growth. That is a sign that margins have improved for this company over the past 10 years. And gross margins for Smartpay, 92.7. Now, that is from Guru Focus. I haven't not confirmed that, whether that is true, but I wouldn't be surprised that this company has gross margins 92.7. And then return on invested capital, 17.8. And whenever I see return on invested capital of a company greater than 15, I'm going to pay attention to that company, particularly if that company can maintain a return on invested capital or even a return on equity above 15 for an extended period of time. Smartpay has to prove that to me at this point in time. I want to see return on invested capital remain above 15 for the next few years. And if it does that and continues to grow revenue, continues to grow earnings per share, that would be a sign that this company is moving towards being categorized as a high quality company. Analyzed total return since 2013, 17.5% per year, which is absolutely great. That's the sort of return you want for a company in your portfolio. Markup increased from 50 million to 400 million, so an 8-bagger when it comes to market cap, maybe not for returns for investors, because again, just like other companies, this Smartpay has seen an increase in shares on issue, but not quite as much as other companies. So shares on issue have only increased from 172 million to 238 million. So roughly about 40% increase in shares. Some of these other companies have seen their share count increase 400% over the past 10 years, but definitely shares on issue have increased. There's been a little bit of dilution, but there is no way you can't be happy with the performance of Smartpay over the past 10 years, particularly if you just focus over the last 4 years. And this will become clear why I've mentioned that when we look at the chart. So let's have a look at the chart right now. Coming in at number 27 is a little bit of a surprise. I did not expect Electro Optics to be in this list. And I think the main reason I was a little bit surprised is because of recency bias, because the share price of this company has dropped 90% in the last 3 years. But if you just look at a 10-year period from 2013 to 2023 and you ignore everything that's happened in between, you should be happy of the Electro Optics performance over that period if you've been a shareholder. But if you are happy, you just had to ignore the last 3 years. But revenue growth, 15.3%. Earnings per share and dividend growth not applicable. because they're not profitable and they don't have a dividend. Gross margin is 48.7, a negative return on invested capital, and the analyzed total return over the past 10 years is 17.7% per year. Again, you would be happy with that if you have amnesia and completely forget about the last 3 years, because the market cap of this company has gone in this trajectory. So 10 years ago, the market cap of Electro Optics was $10 million. And then the share price zoomed higher. It went from something absurdly low to a share price above $10. And when the share price went above $10, the market cap of this company was $1.2 billion. That means this company was a 100 bagger for those lucky shareholders who held during that 6-year period when the share price reached its high in, I think it was late 2019, maybe mid to late 2019. Now, I was a shareholder of this company. I actually am still a shareholder of this company. Now, when the share price reached $100, I started taking profits, but I did not completely sell out. I just maintained a holding, and I've ridden this company all the way down from $10 at a market cap of $1.2 billion to $130 million. Yes, the share price of this company has fallen 90% since the share price high in 2019. And the shares on issue have also tripled since 2013, from 57 million to 171 million. And I wouldn't rule out further capital raisings from this company because they are highly capital intensive and they are winning contracts. And to fund those contracts, there is a possibility they might have to raise more capital. Just a possibility. And I wouldn't be adverse to this company raising more capital, particularly if they win significant big contracts. And now onto the chart, and you can just see the share price from the middle of 2013 when the share price was really low, probably less than 10 cents, something like that. And the share price reached a high of $10.50. I still remember selling a fair few shares in this company when the share price broke above $10. And I remember just seeing it go to $10.50 and went, oh, maybe I did make a mistake. And that is one of the reasons why I maintained a small holding in this company, because just that possibility if the shares just keep on going up. But one of the reasons I did sell, and you can see that in the chart in 2019, the share price of this company went parabolic or exponential. And I always get nervous when I see the share price go exponential. In fact, the share price went from $2.50 to $10.50. In fact, the high in this company was reached in early 2020, so just before COVID-19. Didn't realize it was that late. I thought it was like late 2019 at the latest. And unfortunately, COVID-19 was absolutely horrible to this company. And that's why the share price has fallen significantly and just keeps on going lower. Although it does look like the low has been reached for this company. New management has come in, and it does seem like possibly the new management of this company are turning things around. Coming in at number 26, and the last company in this particular video is another surprising company that I did not expect to see in this list, and that is Serstream. And the reason I did not expect this company to be in this, just like Electro Optics, is because the share price has been under pressure over the past 4 years. Now, this is a provider of essential network services to the telecommunications, utility, and transport sectors. This company really benefited from the NBN network, or the rolling out of the NBN network, and that benefits, or those benefits, have come to an end. Now, revenue growth 8.2% per year, earnings per share growth 2.3%, dividend growth negative 0.5%. I'm not sure if that gross margin of 94.9 is wrong. And the reason I say that is because Serstream has minuscule net and profit margins. So those numbers, that gross margin comes out straight from Guru Focus. So I probably should have a look at that. Return on invested capital 1.9. Remember, I want return on invested capital to be at least above 10, if not above 15. 1.9 suggests to me this company will have difficulties growing in the future. But the analyzed total return over the past 10 years is nothing to be sneezed at. 18% per year. So if you've been a shareholder of Serstream since 2013, you've been happy. Even though, again, just like many other companies on this list, the journey has been wild. We'll look at the chart in the next slide. Market cap has gone from 40 million to 500 million. So market cap has increased tenfold, in fact, 12-fold since 2013, while the shares on issue have more than doubled from 270 million to 620 million. So let's have a look at the chart for Serstream, and you'll be able to see when this company benefited from the rollout of NBN. And I still remember back in around about 2018, 2019, when this company was quite favored. This was wouldn't say a cult stock, but a lot of positive things were said about Serstream because the share price of this company went from about 20 cents to a high of $3. And that was over a period of about 4 years or so. You can just see that chart, a beautiful looking chart over that 4-year period. And then those benefits, those tailwinds of NBN came to an end in the middle or late 2019, and the share price of this company fell from $3 all the way down to about 50 cents or so. But the share price does look like it might be turning around. I believe they bought something from Lend-Lease, so they're diversified how they generate revenue, and possibly the low has been reached, but definitely not a high quality company. And the reason I say this is not a high quality company is simply because of the really low margins this company has. That is all I have for this video, looking at those companies that came in between 30 and 26 of the best performed ASX small companies since 2013. Were you surprised by some companies on this initial list? Or were you not surprised? I was surprised by at least 2 of these companies, particularly Electro Optics and Serstream, but that could be just because of recency bias and other share price has been under pressure over the last 3 to 4 years. I owned 4 of these companies. I was a little bit surprised by that. SideDev, Smartpay, Electro Optics, and Serstream. I've never owned Cogstate, and I've never considered owning Cogstate, but maybe I should change my mind. Do a little bit of research on this company. So leave your thoughts of any of these companies in this particular 5 in the comment section of this video. And the last thing I should say is I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a great day. Bye.